Bitcoin is often talked about as either the future of money or a dangerous financial bubble. Depending on who you ask, it is either revolutionary or reckless. But very few people actually understand what Bitcoin really is, why it was created, and how it fits into the modern financial system. To understand Bitcoin properly, we need to go back to the problem it was trying to solve. For decades, money has been controlled by centralized institutions, banks, governments, and financial authorities. While this system works in many ways, it also has weaknesses. Inflation slowly reduces purchasing power. Financial crises expose systemic risks, and access to money is not equal for everyone. In 2008, during the global financial crisis, trust in traditional financial institutions was severely shaken. Banks failed, governments stepped in, and everyday people paid the price. It was during this time that an idea emerged. A form of money that did not rely on trust in institutions, but instead relied on mathematics and transparency. That idea was Bitcoin. Bitcoin was introduced in 2009 by an unknown creator using the name Satoshi Nakamoto. It was presented not as a company, not as a product, but as an open-source financial system. No CEO, no headquarters, no central authority. At its core, Bitcoin is digital, money that allows people to send value directly to each other without needing a bank in the middle. This alone was a radical idea. Traditional money moves through layers of intermediaries, banks, payment processors, clearinghouses. Bitcoin removes those layers and replaces them with a decentralized network of computers that verify transactions together. This network is called the blockchain. Instead of trusting a bank's database, Bitcoin uses a public ledger that anyone can view. Every transaction is recorded, verified, and secured through cryptography. Once recorded, it cannot be changed. This transparency is one of Bitcoin's most powerful features. Another key feature of Bitcoin is scarcity. Unlike traditional money, which can be printed endlessly, Bitcoin has a fixed supply. Only 21 million Bitcoins will ever exist. This limit is written directly into the code. This scarcity is why many people compare Bitcoin to digital gold. Gold has value partly because it is scarce and difficult to produce. Bitcoin is similar, but instead of mining from the earth, Bitcoins are mined through computation. This process is called mining. Mining is how new Bitcoins are created and how transactions are validated. Miners use computing power to solve complex mathematical problems. In return, they are rewarded with newly created Bitcoins and transaction fees. This process secures the network and keeps it decentralized. At this stage, many people start asking an important question. If Bitcoin is just digital, why does it have value? The answer lies in trust, but not the traditional kind. Bitcoin's value comes from its rules being predictable, transparent, and enforced by code rather than authority. No one can secretly change the supply. No one can freeze accounts without network consensus. No single entity controls it. This makes Bitcoin fundamentally different from traditional money. However, understanding this difference does not automatically make Bitcoin safe or risk-free. Bitcoin is powerful, but it is also volatile. Its price can rise and fall dramatically. This volatility is one of the main reasons people fear it, and this is where most confusion begins. People often mix up Bitcoin, the technology, with Bitcoin, the investment. These are not the same thing. The technology can be revolutionary while the investment still carries risk. To understand Bitcoin clearly, you must separate emotion from function. Bitcoin is not a shortcut to wealth. It is a financial tool. Like any tool, its impact depends on how it is used and understood. And this is exactly what most conversations about Bitcoin miss. To truly understand Bitcoin, it is important to understand how it actually works behind the scenes, without technical confusion. Many people hear words like blockchain, mining, and cryptography and immediately feel overwhelmed. In reality, the core idea is simpler than it sounds. At its foundation, Bitcoin is a public record system. Imagine a notebook that records every transaction ever made. And this notebook is shared with thousands of computers around the world. No single computer owns it. Everyone has a copy. When a new transaction happens, the network checks whether it is valid and then records it permanently. This shared notebook is the blockchain. Each group of transactions is bundled into a block. Once verified, that block is added to the chain of previous blocks. That is why it is called a blockchain. Each block is connected to the one before it, making the history extremely difficult to alter. Security comes from mathematics. Bitcoin uses cryptographic proof instead of trust. To change any past transaction, A bad actor would need to control more computing power than the rest of the network. Combined, something that is practically impossible at scale. This is why Bitcoin is considered secure. Mining plays a crucial role here. Miners compete to verify transactions by solving complex mathematical puzzles. The first miner to solve the puzzle earns the right to add the new block to the blockchain and receives a reward in Bitcoin. This reward system serves two purposes. First, it motivates people to secure the network. Second, it introduces new Bitcoins into circulation in a controlled manner. Unlike traditional money systems where supply decisions can be changed by policy, Bitcoin's supply schedule is fixed. Approximately every 4 years, the mining reward is cut in half. This event is called a halving. Halvings reduce the rate at which new Bitcoins enter the system, increasing scarcity over time. Historically, these events have played a significant role in Bitcoin's price cycles. Though past performance does not guarantee future results, Bitcoin transactions are also permissionless. Anyone with an internet connection can send or receive Bitcoin without needing approval from a bank. This makes Bitcoin especially valuable in regions where financial access is limited or unstable. However, permissionless access also means responsibility. There is no customer service hotline, no password recovery department. If private keys are lost, access to Bitcoin is lost permanently. This level of responsibility is empowering for some and intimidating for others. To understand Bitcoin's real position in the financial world, it helps to compare it with traditional money systems. Traditional fiat currencies like the US dollar are issued and controlled by central banks. These institutions manage supply, interest rates, and monetary policy. This system allows flexibility during economic crises, but it also introduces inflation risk. Inflation slowly reduces purchasing power. Over long periods, money saved in cash loses value unless it is invested. This reality pushes people toward risk, whether they want it or not. Bitcoin was designed as a response to this problem. Its fixed supply removes inflation risk caused by money printing. Supporters see this as a hedge against currency debasement. However, Bitcoin does not replace all functions of traditional money. It is not designed to stabilize prices or respond to recessions. It is designed to remain neutral and predictable. This neutrality is both its strength and its weakness. Bitcoin does not care about economic conditions. It does not change rules based on political pressure. For some, this is freedom. For others, it is inflexibility. Another key difference is reversibility. Bank transactions can often be reversed. Bitcoin transactions cannot. Once confirmed, they are final. This reduces fraud but increases responsibility. Bitcoin also operates globally. Sending Bitcoin across borders takes minutes, not days. There are no exchange rates within the system. One Bitcoin is the same everywhere. This global nature makes Bitcoin appealing for international transfers and as a store of value across borders. Yet volatility remains the biggest challenge. Bitcoin's price reacts strongly to news, regulation, and market sentiment. This volatility limits its use as a daily spending currency for many people. This is why Bitcoin today is used more as a long-term asset than a medium of exchange. No discussion about Bitcoin is complete without addressing risk. Bitcoin is not risk-free. Its price can fluctuate dramatically within short periods. These swings are emotionally difficult for many investors and can lead to poor decision-making. One major risk is speculation. Many people enter Bitcoin expecting fast profits. When prices fall, panic sets in. This emotional cycle is responsible for most losses in the crypto market. Another risk is misinformation. Bitcoin is often marketed aggressively on social media. Unrealistic promises, fake success stories, and misleading claims distort public understanding. Bitcoin is also affected by regulation. Governments around the world are still defining how they will treat cryptocurrencies. Regulatory clarity can bring stability, while uncertainty can increase volatility. There is also technological risk. While Bitcoin has proven resilient over time, no system is entirely immune to unforeseen vulnerabilities. That said, Bitcoin's long operational history strengthens confidence compared to newer projects. Security risk is another factor. While the Bitcoin network itself is secure, users can still lose funds through hacks, scams, or poor storage practices. Self-custody requires education and discipline. Because of these risks, Bitcoin should not be approached as a gamble or shortcut. It should be approached as a long-term, high-volatility asset that requires patience and understanding. Despite these risks, Bitcoin adoption has grown steadily. Major institutions now hold Bitcoin on their balance sheets. Public companies, investment funds, and payment platforms have integrated Bitcoin into their ecosystems. This institutional involvement has changed Bitcoin's role. It is no longer only a tool for early adopters. It is now part of broader financial conversations. Bitcoin ETFs, custody services, and regulatory frameworks have made access easier for traditional investors. This reduces technical barriers but also introduces new dynamics. Bitcoin's role today is evolving. For some, it is digital gold, a store of value. For others, it is a hedge against uncertainty. For a smaller group, it remains a payment system. Importantly, Bitcoin does not require universal adoption to be valuable. It only requires continued trust in its rules and network. This trust is reinforced by time. Each year, Bitcoin survives, adapts, and remains operational, strengthens its credibility. The future of Bitcoin will not be defined by hype or fear alone. It will be shaped by regulation, technology, adoption, and public understanding. Bitcoin is unlikely to replace traditional money entirely. Instead, it will likely coexist alongside existing systems, offering an alternative rather than a replacement. For individuals, the most important mindset is realism. Bitcoin is not a miracle. It is not guaranteed wealth. It is a financial innovation with unique properties and unique risks. Understanding Bitcoin deeply allows people to make informed decisions rather than emotional ones. In the end, Bitcoin is less about price and more about principles, transparency, decentralization, and predictability. Whether Bitcoin succeeds or fails long-term, it has already changed how people think about money. And that impact alone makes it one of the most important financial developments of the modern era.